Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Umesh Revankar, the MD of Shriram Transport Finance, joins on the phone line. Mr. Revankar, good morning. I'm going to ask you about the cost of funds in a bit. But before that, the space that you finance to commercial vehicles has undergone a lot of changes over the last 2 weeks, whether it's the new axle load norms, there was a big trucker strike, and now there's this ban on the 10-year-old diesel vehicles as well. Will all of this put together change the texture of the market and impact your business disbursements in any way?
See, as far as the cost of fund is concerned, I think in the beginning of the financial year itself, it was expected 75 basis, total 75 basis repo increase based on the RBI commentary. So already 25 plus 25 is come. Maybe another 25 is expected. So I think that expectation is there, and we already built in our lending. So we have increased our lending yield by around 20 basis points. So we are able to cover that part of it. But as far as the liquidity is concerned, we are looking at various options, including the masala bond and the ECB. Recently, RBI has allowed ECB for NBFC. So, and also the retail. We have raised retail resources through public issue of 3,700 crores recently. Okay. And we are also public but a deposit-taking company. So we have alternatives and we have different sources. So we are not really constrained by that. And the demand is quite good. Demand we see in the ground is quite good. And we expect to maintain our AUM growth target of 18 to 20 basis point percent over the previous year. So that is the broad outlook. Okay. And as far as the ban is concerned, it is only the NGT ban is only in Delhi for 10 years. Otherwise, it is not there. The scrappage policy, which now the cabinet has proposed, it talks about 20 years above vehicle to be banned. So I don't think there is any challenges on that ground.
Okay. No, actually, the question Sonia was asking you is first to drop the demand position and then to check whether, the demand position is strong enough to bear a few more increases in rates. So, I mean, that's the real question. Is demand healthy, or are these repeated attacks of axle load or bans, are all this spoiling the demand picture at all?
I really don't think so. Maybe the accelerated demand may not be there. When I say accelerated demand, if people are expecting around a 20-25% increase, it may not happen. But if you really look at the deep rural, there is enough demand in the rural, and we have increased our network in the rural in the last 1 year. We have added 270 branches. We are accessing the new customers, so we are able to reach out and grow. As far as the axle ratio on that, the effective increase is around 15% on the vehicle, which is also, as per the manufacturers, they have to redesign the vehicle to increase 15% increase in the overall weight onto the new vehicle that is coming in. As far as the existing vehicle carrying more load is concerned, everyone knows that around 60-70% of the vehicle that is running on the road, they're already carrying the
short point, you don't see a fall in demand.
I don't see any fall in demand, but there may not be accelerated demand because of improving the economic activity.
Okay, now if you can tell us the costs, the cost of funds. How much does a CP, NBFC CP or an NBFC 5-year bond increase for all of FY19 for you compared to last year?
As of now, for first quarter, we did not see any increase over Q on Q. But this quarter onwards, we would be able to see around 15 to 20 basis point increase on the maturity, because we don't have a CP in our books. Our CP is very small. So the impact will be on the repricing of the old NCDs which are getting matured 3-4 years back, what we have raised. So it may not really increase overall cost of fund for the entire book. So we expect it to be around 15-20 basis point, and we should be able to manage.
Okay. Just one final question from my end then. You said 18 to 20% AUM growth is what you're targeting. On the disbursement front, if you can just break it up for us, what the trend is looking like. Are you seeing more used CV disbursements, or is there now demand for more new commercial vehicles? What is the expected trend?
So as far as the first quarter is concerned, there was good demand for new vehicles, but the new vehicle demand is slowly coming down. I feel normally, of course, there is an annual trend. July, August are a little weak month because of the monsoon, and infrastructure activity comes to slow down, and even mining activity comes to slow down. So because of that, it naturally comes down, and I feel it will pick up in August. Normally, around Chaturthi, Ganesh Chaturthi, there will be big demand, and I feel we have to wait till September to see whether we get further boost into the new vehicle demand. Otherwise, as far as used vehicle is concerned, we are reasonably comfortable with the growth on whatever, because of the reach what we are generating.
Okay, can you've still not answered my question of the average cost of money. For an NBFC in general, how much would the average cost of money be higher in FY19 versus FY18?
I feel company like us, which have a reasonably good depth, should be around 15-20 basis points. But if you look at the other NBFCs, which are maybe recently come up, and they may be having a higher pressure, maybe it could be around 50 to 60 basis points.
We'll leave it at that, Mr. Revankar. Thank you very much for taking our call.